So, hello everyone. Again, thank you so much for joining us onto our panel of Breaking into Buyside and the Future of the Industry. So, my name is Laura Sanchez. I am the president of the UCLHFS Society, and I am also joined by Clara Rier. Do you want to introduce yourself, Clara?
Thank you so much, Laura. Hi, everyone. Thank you so much for your time. Today, we're really excited to having you here. As Laura has introduced me, I'm president of UCL Women Finance Society. And for those of you who don't know much about our society, it was founded on the basis to educate, equip, and empower young female students to break into the finance industry. That is why we believe this to be such a great event today. It aligns greatly. And I'm sure they'll be talking more about their recent Spring Week applications, which have opened and we've been promoting. And that being said, thank you so much, David, Kelly, and Lucy for your time today. She's bound to be a great session. Thank you, Laura.
Thank you, Clara. And this event is also made possible thanks to GAIN, which are Girls Are Investors, which is an organization that Clara also kindly introduced, who is about empowering female into the workforce. So now, without further ado, I will start by introducing our speakers. So our first speaker is Lucy Panter, who has portfolio management responsibilities for European performing investments. Mrs. Partner serves on various firm committees, including the Compliance Committee, ESG Committee, and the Diversity Inclusion Council. Prior to joining OHA, Mrs. Panter was a partner and portfolio manager at Golden Tree Asset Management, where she was head of European research. And she focused on making investments in consumer, retail, and leisure sectors. Mrs. Panter was also responsible for managing the firm's European CLOs, and she previously worked at other firms such as Goldman Sachs. Partner earned an MA from Johns Hopkins School of Advanced International Relations and her BA from University College London. So thank you so much for joining us, Lucy.
My pleasure.
Our next speaker is David Linehan, who is an experienced private markets principal investor, having worked as a fund manager over the last decade for the Irish Sovereign Wealth Fund and laterally for Tesco Pension Investments. At the Irish Sovereign Wealth Fund, he originated and underwrote a range of funds and direct investments in private assets, spanning from private equity to infrastructure, real estate, and private credit. David then later joined the Tesco Pension Fund in 2018 to work and build the £2 billion income-generating assets private assets program, where he sourced and underwrote a range of funds and bespoke mandate commitments in private equity, infrastructure, and private assets. He currently acts as a consultant to a number of European credit managers and placement agents. David graduated from University College Cork with a BSc and MSc Finance degrees, and is a graduate of the Financial Strategy Program from Said Business School, Oxford. Thank you so much for joining us, David.
Pleasure. Good evening, everybody.
And last but certainly not least, we have Kelly, who is the head of investor relations at Bayforest Technology. Prior to joining Bayforest, she was head of investor relations at Oakhill Research Investment Management, vice president at Deutsche Bank, and had several roles within marketing at Asset Alliance International and Racing C, as well as being vice president on the best execution trading European cash equity team at Merrill Lynch International. So thank you so much as well for joining us this evening.
My pleasure.
Kelly.
My pleasure.
So my first question, which is directed towards all panelists, is how did you get started in your investment career? And anyone feel free to take it away.
Okay, I'll jump in. Mine wasn't a straight and narrow path at all. I have a creative side, so I was also pursuing thoughts about joining like the art industry or something like that. And I got a job at the Saatchi Gallery, and the Monday I was supposed to start, I had spoken to a headhunter before, a finance headhunter, and I showed him an article that I saw about Merrill Lynch, and this will come into my culture answer a little bit later on. The article was highlighting why Merrill Lynch was such a good place to work, and I absolutely love reading it. And I went to him and I said, I don't want to work for anyone else. I want to work for this company. And he sort of said to me, this is not really how it works. You know, what is it you want to do? And I was like, I don't care. I just want to work for this company. And the Monday I was supposed to start, he actually got me an interview instead. So I left the offer with the Saatchi Gallery, and I actually went to take the interview with Merrill Lynch. But that obviously wasn't the buy side. In 2005, with the market crash and everything, a lot of the prop teams were being sort of made redundant or leaving, and a lot of people started going into hedge funds. And at that time, no one really knew what a hedge fund was. I mean, obviously it was a lot of people that, you know, knew, but the majority of people didn't really know. And, you know, I put it into Yahoo because there was no Google at the time, and nothing really came up. There was no articles, there was no help, there was nothing. So I did speak to a few people about it, and what I found was it was a very boutique, very interesting, very entrepreneurial type setup. A lot less people, no corporate culture, anything like that. And my job itself would have been very different from market making, but, you know, we're sort of talking more business development, talking to clients, raising assets. And that really caught my attention. And I did, I joined one. The interview process was fairly simple because people were just looking for anyone who had finance experience, or they understood the product, or they had contacts with clients. So that sort of transition wasn't necessarily difficult for me, but that's how I actually joined. So it wasn't, you know, went to the university, did the whole, I want to work for this person or that person, and sort of made like a path towards it. I sort of chose a slightly different one, but ended up in the same place.
Okay, thank you. And in your case, David, how was your transition into the buy side?
I suppose for me, I worked in investment banking for about a decade. So I went the sort of a reasonably traditional route, in a sense, in that I studied finance at university, obviously in terms of my degrees, and then got offers from grad programs. Number of investment banks, went in and sort of did that for about a decade. So I worked in sort of equity capital markets, M&A, doing a lot of advisory work. And I enjoyed a lot of aspects of the job in terms of, I suppose, the challenge and working with large corporates and doing interesting deals. But it was never as, I suppose, sort of satisfying, and was probably aspects in terms of the sort of the culture, you know, within investment banking that didn't necessarily appeal to me either. And I suppose after a sort of decade of that, I sort of thought that, you know, moving into, you know, investment management in some form would probably align more with my sort of interests, my values. And that was where I sort of made the transition. I moved from London back to Dublin in about 2011, and I ended up getting a job at the Irish Sovereign Wealth Fund. And that's basically been the sort of start of my sort of investment management career. And I think for me, what I've sort of discovered over the last sort of decade, you know, when I sort of compare the two businesses, in the sense, is that in investment management, it suits my, I suppose, my interests, my skills, much better, because it's more, I think investment management is more multifaceted in nature, in a sense of, if you're somebody that has an interest in, you know, in markets, in politics, in finance generally, you can bring all of those elements together. So it's you know, it is challenging and interesting in sort of equal measure. So I think, you know, in a sense, it's been a little bit of a sort of journey of discovery for me, of working in investment banking and then making that sort of transition over and sort of seeing the differences between the two. But certainly, I don't regret having made the move. Maybe in a sense, my only regret might have been not doing it quickly enough. But again, that's all part of the journey, you know, in terms of sort of career development.
I guess it's really hard to know at the beginning what you want to do later on. But let's, I think, Lucy, you can also share how was your transition into the buy side, and why did you choose it as opposed to any other industry?
Sure. Like David, I also started in investment banking. I think that was, you know, back then a slightly more traditional way of starting in, you know, investment banking and then making the move either to private equity or to a hedge fund. I started in investment banking in New York, and it was quite you went in as an analyst, and then at sort of the end of your second year, a lot of people either went to private equity or moved on to hedge funds. I chose to move to a hedge fund because I was much more interested in markets and the way markets moved. And I knew that I wanted to be on the credit side, so I started in distressed debt in the early 2000s, which was just at the sort of the end of the dot-com bubble. And so it was a great time to do that. So I was really only in banking for about 2 years. And for me, it was because I wanted to be a thinker and I wanted to be a principal. And so it was quite a relatively easy decision. I would say now you don't necessarily need to go to investment banking in order to get into investment management. It's a lot easier just to go into investment management. You know, hedge funds hire graduates. We hire graduates. We have our own graduate training program, similar to the banks. And that the ability to get trained wasn't there. You know, I was at UCL I started at UCL in 1991. And so that was obviously rather a long time ago. And then it was much harder to break into the buy side. And as Kelly said, in 1991, hedge funds didn't really exist as hedge funds. There were firms doing things, but you know, it was really only in the early 2000s that it sort of took off.
Mm-hmm. And it's really interesting to see how much the industry has changed throughout that period of time. So I think that my next question is now directed to David. So you've been in the finance industry for almost 20 years, having joined straight from graduation. And related to what Lucy just mentioned, how do you feel that the industry has changed since you first started? And how has your strategy as an investment professional changed because of it?
Okay, there's probably a couple of aspects to this that I would highlight. I would say the first point, I suppose, for me is in relation to the growth of sort of what we call private markets or private assets. So when I talk about private markets, I'm really thinking about sort of private equity, infrastructure, private credit, real estate, you know, as sort of areas of this, and obviously hedge funds, you know, as part of that. And I would say just the growth, scale, importance of private markets within the investment management industry has just been extraordinary. Because I suppose most people will know, you know, private equity has obviously been, you know, a very long established asset class, and it's been, you know, it's been around in sort of one form or another over the last, you know, the last sort of 40 years, I suppose, in a sense. But if you think about other areas of private markets, infrastructure has had extraordinary growth over the last sort of 10 to 15 years. And private credit, which is an area that I know particularly well, having invested quite a lot of money in over the last sort of 4 or 5 years, is really very much the sort of the coming area within private markets. So if you were to sort of take these areas in their entirety, they become very, very significant areas of investment. And, you know, if you were to look at surveys, you know, many of you might have seen sort of articles in the FT or other places. If you look at the sort of investor intentions over the next 2 years, everybody's talking about increasing sort of exponentially the amount that they're going to invest in private assets of one form or another. Obviously, private equity is the most significant, but infrastructure has been, you know, catching up fast, and private credit, I think, will experience, you know, pretty high growth as well over the next number of years. And a lot of this is just being driven by, I suppose, clearly the low interest rate environment that we're in is obviously, you know, driving people to increase their sort of exposure to private assets. But also the other big trend is that a lot of sort of investment or financing activity that was typically done, you know, within what we might call public markets, whether it's equity markets or being done by banks, for example, is now done in various forms of private markets. So it means that the sort of the opportunity set for investors in private assets is very, very significant. And that's why you're seeing more and more pension funds and other types of asset owners, you know, massively increasing their exposure. So for me, that's been a huge change. It's a huge structural change, and I think that growth is going to continue. And I suppose the other point to highlight then is probably around ESG, and obviously ESG gets talked about by everybody, and it's become very much a sort of mainstay of investing both in public markets or indeed in private markets. And I think that's obviously been driven by sort of various stakeholders and trustees of pension funds, and pressure from regulators, governments, etc. So I would sort of highlight that as the other aspect that is causing very significant change in the investment management industry. And obviously that's only going to increase over the coming years, because occasionally I get people sort of asking me, is ESG, is that something that's sort of it's a little bit faddish, or it's something that it's sort of flavor of the moment, and you sort of have to point out to people that no, it's very much a critical part of investment management. And for anybody pursuing a career in this industry in the years and decades to come, it's going to be a very fundamental part of what you invest in and how you invest. So I'm sure we'll come on to this with some of the other questions, but I think it's an area for everybody to focus on and sort of build their knowledge and awareness of in the coming years.
Mm-hmm. Absolutely, and especially the topic of ESG, as you mentioned, has been driving investor decisions for a long time now. I'm curious about Lucy. Do you have anything else that you wanted to add, especially yourself sitting on the ESG committee?
Sure, look, you can answer this many ways, in that we have all been doing ESG analysis for a very long time. We simply didn't call it ES&G because as a credit investor, particularly, you're always thinking about your downside. It's quite interesting. If you had any equity investor here, they're always thinking about their upside, whereas credit investors are always thinking about, how can I get hurt? How am I going to lose money if I'm wrong? Because when you're a credit investor, all you can ever get back is the debt that you have lent and the coupon that you're owed. And so you're always thinking about your downside protection. And so if you think about it, when you're thinking about an environmental business, a chemicals business, for example, you're thinking about what are the contingent liabilities? Have there been any chemical spillages? So you're sort of taking E into consideration. G, frankly, governance is just good practice. So all of us should be asking all the time about what is your board structure, how many members of the board, all about governance. And so the reality is we were doing a lot of ESG before, but we weren't necessarily calling it that. So it's now a more formalized process. And I now think there's acknowledgement from everybody that ESG actually enhances returns. So it's not as though ESG is a cost center. ESG, good governance, good S, i.e. treating your employees well. And I think it's fascinating how when you speak to some of the private equity guys, people today, a simple thing such as sharing ownership, so that actually how far does the equity ownership go down? Taking the equity ownership down through all the levels of a company is a win-win, because then you get your staff more on board, more involved with your strategy. When you sell the business, they know that there's upside for them, and so they're only going to work harder. So the reality is a lot of ES&G actually complements business and makes a lot of sense. Mm-hmm. So we spend a lot of time on it. It's also being forced upon us by governments, regulators, and our investors. But I think it's only making us better and stronger for it. So we spend a lot of time on the subject, and we try not to even call it ESG anymore, but really sustainability, because I think that encompasses a lot more. But it's obviously a key area of focus. I would say, and I'm sure David would say the same thing, that on the private side, the data isn't there yet, because a lot of our companies are somewhat and I don't like the word journey, so I apologize, but they are earlier on their journey than you are on the public side. And there has to be an education around carbon and how do you calculate that. And we also, I genuinely think that you have really strong accounting boards for accounts, and you need to get to that for ESG so that all companies are measuring carbon in the same way. And I think you will get to that. We're not there yet, where there is no standardized, how do you actually measure carbon? And so that's something that I'm working quite closely with a bunch of different financial regulators on seeing if we can get standardization. But it's obviously a hot topic. D&I is another area where we are very focused. To my shame, this is the first year I joined the buyside in 2001, and I have had no female investing colleagues either in New York or in London until the last 3 years. And so that is something that is a very big push for us, you know, which is what GAIN is there for. And I think events like this are great. You know, this year, I'll give you know, it was actually really disappointing. We launched our first summer internship program last summer, where we went out to sort of 15 universities. And I really thought that we would be maybe 60-40. And in the end, we had 60-40 being 60 men, 40% women. We had 190 applicants, and we had 187 men and 3 women. And that's when I suddenly realized that actually we needed to do more to make women aware that an investment bank, you know, everyone's aware of investment banking. I just don't think they're as aware actually that you can have a career in investment management, and you don't need to. It's great if you want to go to investment banking, but you actually don't need to go to investment banking. You can come straight into investment management and start, you know, from the ground up and get an equally as good training. But that was a very long-winded answer, so I apologize.
No, thank you so much. That was definitely a very comprehensive answer. And of course, it's a lot of work to be done in the industry. There's still a big knowledge gap on what type of careers there are out there when it comes to finance. And then the next topic, especially for people still considering what they want to do. And this question is directed towards Kelly. So you have worked in a wide range of different companies before joining Bayforest. And at the same time, you've also had different roles and then being head of investor relations at 2 different companies, having also been at Oakhill Research Asset Management before. So how important would you say that culture is when joining a firm, and how can you assess that?
I think it's one of the most important things, especially now. I mean, culture, the way we look at it, it's culture to a workplace, to a firm, is exactly what a personality is to a person. So you're looking for that fit. You're technically spending most of your waking hours in this place. It has to, you know, align with your own vision, goals, your processes, your mission. You need to understand what is the tone of the business, what are their contract terms, how do they treat their employees, how do you fit in there, what are you bringing to the table, what are they bringing to the table. It's one of those sort of things where it literally has to be one of those perfect fits. When I do interviews with like some of the firms I've joined, and those are really long processes. I mean, even back at Merrill Lynch was my longest interview process. I think I had like 20, 25 interviews. And that was, you know, in investment banking. And you're going through this entire process. You're trying to glean from each person that's talking to you. What are they actually trying to tell you? What are you picking up from what they're not saying? What is this business doing? You know, there are a number of ways to sort of look at culture and like how you can fit in. But, you know, the broader picture and the company's identity, its image, you know, the staff that they're hiring, their suppliers, their press, everything that's actually out there about a company, that sort of comes under culture. It's more than just a paycheck. People now, especially like in the last 2 years, everyone's searching for that perfect work-life balance. We're achieving something closer to it with, you know, a work from home situation. So the culture of the firm also comes into play here, because then you have to think, are they willing to let us do this? Are they willing to let us work autonomously? Are they willing to not micromanage? Are they willing to trust me that I know what I'm doing? Are they willing to listen to my input? Are they willing to take that on board? Do I add value to the company? You know, what I do, you know, you need to see the appreciation as well from the other side. Like, you know, everybody wants to feel like what they're doing doesn't matter. You know, you want your work to be recognized. You want to know that your part in that process fits into a bigger picture. And, you know, it's a massive team, and you're spending time with a lot of people who are either like-minded or not like-minded. You know, both works in different settings. I mean, with like some of the places I've been before, so where I was at Deutsche Bank, that's a very corporate culture. It's a lot of tick boxes. It's a lot of basically doing what you're told, and not necessarily too much more outside of that. There is a supply chain, and you fit somewhere in that chain, and you're literally doing a set list of processes until you sort of scale up the ladder a bit, and then you sort of get seen, you're a little bit more visible, and then, you know, things change and all of that. But when you move on to like an investment management company or a hedge fund, there is so much more, because you're in a firm where you're rolling up your sleeves to do 3 or 4 jobs. But also you're learning so much more. You're part of a bigger process. Your impact is so much bigger. I mean, when, like, I think in interviews, it's something that you technically need to spend a lot of time in identifying what is the culture of this firm? What does that mean? How are they answering this question? What are they doing for their employees? You know, how do they define success? How do they define failure? What do they do to address either of these? So I feel in terms of retaining good people, because obviously that's the end goal. And, you know, you know, like, what are you doing to sort of keep them? How are you keeping them valued? How's everyone feeling comfortable? I think that's sort of like working out, how does that fit actually work for both sides? So it is one of the most important things to sort of work through in an interview, because you're spending, you know, like a fair amount of your time at this place. So it really needs to work and sort of align with your own values.
I was also curious to know your perspective, David, having worked at investment banks as well as sovereign wealth and asset managers. How have you seen the culture being different across the different types of firms, and how was your experience?
Yeah, I think for me, I suppose what's been interesting is I've worked in sort of large scale and sort of smaller scale organizations, and I suppose it's also working in sort of established and more entrepreneurial and environments, and just the differences that you get from those, and clearly there's sort of pros and cons. You know, working in sort of larger, you know, investment banks, for example, you know, sometimes people can sort of get the impression that, you know, there's a huge amount of sort of negatives with working in those places, but that's obviously not necessarily the case, because clearly, you know, in terms of particularly earlier in your career, you know, there can be benefits to working in larger organizations in terms of, I suppose, that sort of training, and in terms of sort of client exposures and aspects like that come from, you know, working in those larger organizations. And then potentially over time, you may find that going into places that are that bit more entrepreneurial, smaller scale, we have more responsibility, the ability to make more of an impact, you know, starts to appeal to you as you develop your sort of experience. And that's probably what I found, certainly, is that in the first half of my career, in a sense, working in investment banking and taking a lot from, you know, working in those sorts of organizations, and, you know, working on sort of large, high profile deals, and working with a lot of very experienced people, you know, working in those environments, a lot of good things coming from it. But then sort of over that time, discovering that culturally, okay, this is not necessarily the sort of place that I may want to be in over the longer term. So it's sort of taking the good bits from it, sort of learning, in a sense, learning sort of what works for you, and helping to better sort of define what it is you want over time. So I certainly sort of feel like I've gone through a little bit of that journey. And also I've been fortunate in a sense then, in terms of my investment management experience, that you know, I joined sort of 2 buy-side organizations that were at sort of interesting points in their development. So I went into a sovereign wealth fund when the mandate of that fund was changing from a traditional sovereign fund into more of a sovereign development fund, which in effect meant that we were starting to invest in support of sort of economic activity and employment. So we had a double bottom line mandate, which was doing more economic impact investing. So I personally found that very, very interesting because it gave a sort of greater purpose to what we were doing in investing. So we weren't just investing to sort of make money, generate returns, you know, in the traditional kind of way, but we were also investing so that we could create jobs and we could create some social impact. So having, again, a sort of broader purpose to what we were doing. And I guess increasingly over time, that's what I found has sort of appealed to me. And I would probably have that as the sort of single biggest differentiator between working in investment banking and working in investment management, is that particularly in investment management organizations, if you're working for a pension fund or a sovereign fund or some kind of investor in that way, that purpose dimension to what you do is very interesting. And I think it's quite a big motivator. And I think it's probably going to be increasingly a motivator for people going forward, is they want to feel like they're doing a job where, yes, you're doing interesting work, and you know the investment world is sort of challenging and interesting, but also if you can have that purpose dimension to what you're doing. So for example, when I worked at Tesco Pension, you know, you were investing on behalf of the 350,000 workers that Tesco employs. So you're investing their pension savings. So you're looking to sort of work to generate, you know, better sort of retirement outcomes for Tesco workers. So that's an interesting sort of purpose dimension to what you're doing. So to me, that's probably the really interesting aspect. And I'm sure we'll come on to this with other questions, but I think increasingly, I think a lot of the investment management industry is going to move in that sort of impact sort of direction, whether that's economic impact, social impact, environmental impact. Obviously, there's lots of different ways you can measure it, but I think that's going to be the really interesting next sort of leg, in a sense, in terms of the sort of development of the investment management industry. And it's going to create a lot of really interesting opportunities, I think, you know, for all the people sort of on the call that are going to look to sort of pursue a career in the industry.
Mm-hmm. No, and definitely, I think impact investing is and many others that you've mentioned are definitely going to be driving the industry in the future. I think also now discussing what are going to be the next trends and what the current situation is in the market. So one of the questions, and this is open-ended, so anyone feel free to take it. It's given recent economic expectations in developing economies, which one of them can be the tech crackdown in China. Would you consider that emerging market equities are losing their historic appeal? And in your opinion, which emerging markets might turn out to be winners and losers in the future?
Will I jump in and give a view on this?
Yes, of course.
Sure. So I would say from I suppose from my perspective, as I look at this, I mean, you do see a lot of commentary on this, and I suppose a relatively sort of pessimistic views on some aspects when it comes to emerging markets. But for me, I mean, when I look at this, I think that some of the sort of stories in more recent years are don't necessarily apply going forward. So you see obviously a lot of talk about China, for example, in an emerging markets context, and obviously a lot of concern about China in sort of more recent times. But I think if you were to look at the influence of China on a lot of, say, Asian emerging markets, it's not as significant as it once was. So the ties between China and a lot of these markets is you know, that sort of interdependence has weakened in the last number of years, and China has become a little less important. And what I think is really interesting this year, if you look at a lot of the data and you look at a lot of the investment activity, India is probably, you know, a really interesting market. Clearly, India has benefited from what's happened in China, in the sense of a lot of flows have moved, or a lot of money that was going into China, a certain amount of that has certainly gone to India. So if you look at the sort of venture capital flows into the Indian market, look at the number of unicorns that have been created in India, say in the last year versus the previous year, you know, the numbers are massively up. And clearly there's been some very large IPOs in the Indian market. I mean, you look at the Nika IPO recently, I think the price doubled on the first day of trading alone. So, you know, for me, India is a really interesting market. It's got a lot of really, I suppose, sort of fundamental advantages to it, whether it's, it's the sort of the English language, or the relative political stability, size of the market, all of these kinds of factors. So I think India is going to be one of those really interesting sort of markets over the next few years, and it certainly grabbed the attention of a lot of the venture community as well, benefiting from, I suppose, some of the volatility and the sort of political concerns in China.
And Lucy or Kelly, do you also want to add anything to that?
No, I think David did a pretty good job summarizing that one for me.
Okay, then we can maybe go on to another interesting questions, which are new investment ideas that are starting to gain traction in the markets, and some of them are cryptocurrencies or ESG investing, which both are some that we've discussed briefly before. So would you consider that those are suitable for asset management professionals wishing not to be left behind, or are there still some considerations to be taken?
Look, I can't really comment on crypto, to be honest. I am a fundamental credit analyst where we're trained to do deep value analysis on companies. And crypto is, I don't understand it, if I'm totally honest. NFTs, crypto, some of the, and you guys could probably explain it better than me. Some of the younger guys on our team do a little bit in crypto, but it's not our sweet spot. ESG investing, as I said, we don't have a bespoke ESG fund, but every single company that we invest in, we do ESG analysis on. And so I think we will continue to do that. And we do that whether it's in distressed funds, private credit funds, or our liquid credit funds. So that is clearly going nowhere. You mentioned briefly impact investing. I think that will become more mainstream. And then, there are some thematic investing. I think healthcare is a really interesting space. And so, we spend a lot of time on healthcare. It's also a very broad sector where it's sort of 5 subsectors. It's regulated, demographics are going in your favor. And so I would encourage anybody to spend time on healthcare. It's a really interesting space.
Also, David or Kelly, would you like to add anything onto recent trends, whether it be cryptocurrencies, impact investing, or anything to add on to thematic investing?
I think Lucy did a pretty good summary there. Crypto investing and NFTs, we have a very similar outlook about that. And I work with a lot of guys who are technical and, where we're doing a lot of machine learning. So the fact that they don't buy into it, but they read the news and they're aware of it, it's interesting, because I think if they don't buy into it, then it just makes me put a big question mark over the whole thing. I find it super complex and pretty difficult to sort of get your teeth into. One of the other things that I do feel like a lot of people are looking at, which is where I sit, is machine learning. It is interesting. It's a dynamic space. It's quite technical as well. There's a lot of ways to sort of get into it, but also it's one of these things where you really have to spend the time to sort of look at the space. Quants on the whole, it's super technical, and the skill set, it's a very small pool of people. So like my portfolio manager, sitting with him in a meeting, you literally know within 5 seconds if the person sitting opposite is understanding what he's saying, which is not very often. So machine learning is something that I think is also like the new buzzword, I guess, in the space. With ESG and how we operate, it wasn't something that we decided to do on our own. It was something that was very much investor driven. A lot of the very big investors around the world, all the big pension funds, it was something that they've been looking at for a long time. And now that's feeding through into all of their investments, of all of the underlying funds, everything that they hold. And you have to sort of find a way to sort of work out how does that actually fit? How does it impact what you're doing? And does it make sense? So it became, I think over the last maybe 5 or 6 years, via consultants and some of the other market providers, it became a very, very big flag that we all had to pay attention to. And now I feel like it's becoming a little bit more mainstream. I think Lucy mentioned earlier on, there's a lot of gray area in like how everyone's sort of being defined when it comes to ESG, and how is that all working and how is everyone being aligned? So it's slightly technical still, but at the same time, I mean, it's something we can't avoid. So definitely ESG is one of our biggest flags that we're addressing at the moment from our perspective.
Absolutely. So just to remind everyone, so we have 2 more questions for the panelists, and then we'll break into Q&A. So any questions you'd like to ask, please feel free to post them in the chat, as I've seen some people have already started doing. So my next question, which is really directed towards anyone, it's what are some investment ideas, investment strategies that you have taken in the past that have gone really well, but more interestingly, what were some that went totally wrong, and what did you learn from those? So just Kelly, I see that you were smiling after that question, so you would like to go first.
Oh, no, not at all. I mean, I sat with a Japanese fund manager that we spun out from Deutsche Bank in 2012, and they did a lot of fundamental investing, obviously in Japan. And Japan is one of these places, either you like it or you don't like it. It's like Marmite. You like it, you don't like it, you get it, you don't get it. And it's very cyclical. So it was one of these things where, a lot of things went wrong over there. But sometimes they do become the flavor of the month. I mean, I can't sort of pinpoint particular things that went wrong, but it was just an example of Japan is just, hit or miss. I wasn't particularly smiling to answer. I was just remembering that was a pretty hard sell for a few years.
Yeah, absolutely. And some sectors are, of course, really hard to predict. Japan might very well be one of those. So, David, do you have anything you'd like to add?
Yeah, I suppose in terms of things like I can sort of highlight, I suppose I was fortunate in a sense, particularly in my time working at the Irish Sovereign Wealth Fund, that we had a very sort of broad mandate in terms of sort of asset classes that we could invest in, and in terms of sort of investment structures. And one of the things that we did early on, which has become quite a big area of sort of growth subsequently, was in terms of giving sort of public market investors, so giving equity market investors access to private assets. So the whole concept of what you might call sort of listed private assets has become very, very big over the last sort of decade. So you will see this with, for example, a company raising money at IPO to invest in renewable energy projects, for example. So that whole concept of giving public market investors access to what were traditionally sort of private assets, whether it was infrastructure, it was real estate, it was private credit, that's become a really significant area. And it was something that we certainly, in my time at the Sovereign, we sort of identified very early on, sort of 8-9 years ago. And we sort of cornerstoned a number of listed vehicles. And again, for us, it was very much about trying to drive greater sort of investor interest and capital flows into things like renewable projects. Because again, by creating these sort of listed vehicles, it was a means of giving obviously liquidity to people who had initially invested in renewable assets, and it just helps to sort of grow the overall sort of capital flows into areas like renewable energy, which obviously is it's sort of desirable sort of social, economic, environmental sort of dimensions to it. So that's one area. And then I suppose the other area I would sort of highlight it from a private markets perspective is what we call sort of secondary funds. So the sort of trading of I suppose stakes in existing fund investments has become a very big area, clearly in private equity, but it's also grown more in infrastructure, and it probably will grow in private credit over the next number of years as well. So I think I would sort of highlight that as a really interesting strategy where a lot more capital is sort of going to flow into, and it's just a natural consequence of private markets as a whole sort of growing and maturing a lot more.
Mm-hmm. Thank you. And Lucy, do you have any example of investment strategies that might have gone totally wrong?
Look, I have made many unfortunate mistakes in my career, and I think what I have learned from that is when you see an ice cube that is starting to melt, it generally melts faster than you think. And I'll give you an example. You guys probably don't know necessarily what yellow pages were, but when we were growing up prior to Google, you had these very big yellow directories which told you anytime you wanted to find a local garage, a mechanic, etc., you would go into this phone book. These were great debt stories because every year everybody would go back, they would advertise in these yellow pages, and they threw off a lot of cash. Along comes, the internet, and all of a sudden the internet's sort of competing, and nobody expected that yellow pages would go like this as quickly as they did. And then the problem was that the yellow pages needed to spend a lot of money in order to become online businesses. And so while their revenues were going down, their costs went up. And it was a disaster for the debt guys. And I think what I learned from that is that when companies start going into structural decline, it happens quicker than you think. And I highlight this because this is it is such a fantastic privilege to do what we do, because every day you're being paid to think. You're being paid to come up with theses and then prove them through numbers and data. And so I highlight that where you're taking a macro, or you might take a macro trend, which could be something like agriculture. Developing countries as they urbanize and as agriculture becomes more mechanized, how do you play that? And then you can think about all the different derivatives of ways to invest, because clearly the first line would be tractors, but generally that's already played out. But then the second line may be tractor wheels. And so actually then could you go into or replacement parts? And so you can sort of create that thesis and say, this is my thesis. How best do you think we should play that thesis? And so it's such a privilege to have that. But on the flip side, you have to think about, okay, this industry is in structural decline. Doesn't mean you don't necessarily want to invest, but make sure you get in at the right point into that investment. And then the other thing you have to be is deeply skeptical, because unfortunately there is fraud and management teams do lie. And our job is to push, pull, and prod to find the truth. So it's also a wonderful job because you are taking numbers, but then you're looking at somebody in a meeting and trying to put them under pressure to see how they react.
Mm-hmm. Thank you. So we will now go on to a Q&A section. So first question is from Ravindra. So Ravindra, would you like to unmute yourself and ask the question?
Hello.
Yes.
I had a question about, like, if you see the current hiring process and the current competition in the market, what do you think about that, and how do you compare it with when you were first trying to enter the buy side or the investment management industry?
For sure, I would never have been hired. You guys are way smarter than I was. And so when I see your resumes and the accomplishments and the grades and everything else, I am blown away. But so I think it's harder, without a doubt. But I also think that it doesn't mean that it's there's lots of, the finance industry would tell you though that actually lots of people want to go and work in tech or different areas, and so actually it's competitive, but it's not impossible with the backgrounds that you guys have, is what I would say.
Thank you. My other question was related to a bear market. Like most of us have never really experienced a prolonged bear market. I wanted to know if you have any stories or experiences of investing in a bear market, and is the process different? The investing research process?
It's brutal. It's emotional, it's brutal, but it also offers some of the best opportunities. So you just have to keep a cool head. I'll never forget in 2008, going into the office every day, and the fund was down, the fund was down, the fund was down. And you start worrying about, you know, are our investors going to pull their money? That's where Kelly and her team come into play, because they have to face the investors every day. But when you've taken money in from an investor and you're down 10, 15, you know, in 08, it was brutal, but you have to be cool-headed and go back to your numbers and look at your models as an analyst and say, is this, for want of a better term, is this the baby being thrown out with the bathwater, i.e. the whole market's down? That can actually be the best time to invest if you are confident in your numbers. And that's when I am stressed out. I just go back to the models, I go through the numbers, I then run a downside case. And then now I'm the PM, so it's slightly different. But when I wasn't the PM, I would go to the PM and say, you know what, I believe that this is, we invested in it at 100 cents. Now it's at 80 cents. I still think it's cheap. This is my thesis. And go back to your numbers. And every time you go back to your numbers, they tell the truth.
Yeah.
So bear markets can be some of the best times, but they're also brutal. It's desperately emotional and hard when you've taken money from somebody and you've promised them a certain return, and then you have to go back to them and you have a down year. But hopefully investors are also there for the long run. Anybody that wants to invest for 12 months in a short period really shouldn't be, frankly, giving us money, because we don't think about things, you know, we're thinking about things for a much longer period.
Thank you.
Our next question is from Clara.
Yes, thank you, Laura, and thank you so much for this discussion so far. It's been really interesting. I was just really curious to know, so given the current macroeconomic climate, you know, we've got inflationary pressures, bottleneck supply pressures, this new variant, the Fed becoming ever more hawkish. I was curious to know, what do you think are the major or potential risks that you will see in the coming, I don't know, 3 to 5 years? And what is your strategy to kind of mitigate those risks and kind of like, you know, protect your portfolio? Thank you.
I'll give an answer from a sort of private markets perspective. I think probably the biggest risk, in a sense, as I think about various areas of private markets, is really going to be on, I suppose, the sort of returns outlook, in a sense, and the sort of delivery of returns. And obviously there's a lot of different factors that can potentially impact on that. But I think, you know, a very significant one in private markets, and it probably particularly applies in private equity, for example, is in terms of the inflows of capital and the competition for assets. You know, is becoming ever more intense, and obviously, you know, the more competition you have, you know, the more risk there potentially is to delivery of the returns. So I think, in a sense, if you're looking at this from the point of view of allocating capital, you know, and sitting there as you know, whether it's a pension fund, a sovereign fund, or whatever it might be, you know, you've got to be focusing on certain aspects, you know, that are going to help to sort of mitigate that risk around the returns. So that may well be, you know, looking at areas that are slightly less crowded, where there's less competition. You're focused on managers who are genuinely differentiated in terms of their ability to source deals, for example. You know, so you have to be sort of looking forward in terms of that environment, and thinking, you know, this sort of low return environment is probably going to persist, which means that, you know, the competition for assets is going to continue to be as intense as ever. And then focusing on, you know, where people can potentially differentiate, and where you can have, I suppose, greater confidence that those returns are going to be delivered in the future. And that's always been, certainly for me, a very significant part, when I'm evaluating strategies, where I should be investing, or indeed who are the managers I should be allocating the capital to. So I would say, those challenges have obviously been there over the last number of years, but it is certainly becoming ever more difficult, in terms of that returns outlook.
Thank you. So the next question, which I will read it in the interest of time, is from Dan. So his question is, do you think the current supply chain disruptions and the concomitant move towards self-reliance and industrial policy in such sectors such as microchip manufacturing will advantage smaller innovative firms more or less than established oligopolies? Interesting question.
That's a nice, easy question.
Definitely.
Well, I'll give one perspective on this. I mean, for me, sort of thinking about that kind of question, I think absolutely, this whole point of sort of self-reliance, self-sufficiency, it is a very big sort of macro trend. And, it certainly, it's sort of rooted in the sort of geopolitics as well, clearly. And even if you look at comments from the European Union, from some of the ministers and from the European Commission itself, even in the last few weeks, where they have been raising this as an issue and saying, the European Union, for example, has got to become more self-sufficient in areas, whether it's sort of food production, it's energy generation, these kinds of areas. So there is definitely, there's a clear and obvious trend for these large trading blocks, or indeed for countries themselves, becoming more self-sufficient. So I think that is definitely going to play out as a broader trend, and it's going to impact. We're already seeing the impact in some industries, and I think it'll continue to spread. So I think that I would absolutely agree. It's a very significant issue, and it's one to be very sort of mindful of. But I think on this point of whether the sort of smaller or the more established will benefit from, in a sense, there's a part of me that thinks that it'll always be the more established, because the more established players will have this sort of obvious cost advantages, and they'll benefit more from this. But then when it comes to the smaller, more innovative firms, ultimately a lot of it will come down to competition policy. Because if you look at what's happened in, I suppose, a lot of areas of tech, for example, the trend over the last number of years is you have more smaller innovative firms as they grow, they scale, they create good products, but then they get bought out by the established players. So the Facebooks, the Amazons, the Microsofts, these guys, they just come in and they buy up these firms because they've been allowed to do it. So in a sense, for me, it's probably going to be about competition policy and regulators, and whether they step in more over time to stop these larger players from continuing to buy out, the smaller, more nimble, more innovative firms. And there certainly seems to be a move in that direction. But whether that happens, in terms of regulators, probably ultimately it'll be a sort of political decision. I think it'll vary, but there does seem to be more of an appetite to sort of put more constraints on some of the larger players from just continually buying up the smaller players. So it'll be an interesting dimension to sort of see play out over the next few years.
Definitely, and it's going to be something to watch out how supply chain is going to play out when looking at pretty much all industries. Now, our last question of the panel, which is from Carlos Sanchez. So he said it has been very interesting to know the reasons why you all entered this industry. So his question is, after these years, what is it that keeps you still in? Is there anything that has changed in terms of your motivations?
For me, none. It is every day coming in and looking at new companies, new investments, meeting new management teams. And it is such a massive privilege to see, to meet people that have CEOs that have created businesses, private equity who are investing capital in businesses, meeting pension funds and investors. And so, I think I am as motivated as ever. We recently sold our business to a long-only asset management firm called T. Rowe Price. And the founder of our company, who started this business when he was 28 and is now 65, will tell you that he's still in the first half of his career. And he has no intention of slowing down or stopping. And it really is, a career that, because you look at so many different types of companies, different asset classes at different points in the cycle, there's always something to do.
I agree. I think Lucy's nailed it. It's very motivating, sort of going through all these different cycles, market cycles, crashes, bear markets, bull markets, all of it, but sort of coming out of it and sort of seeing how things have evolved, how you fit into that, how, like our business itself, hedge funds back in 1995 to what that business, that industry looks like today are very, very different things. It's much more regulated, it's much more mainstream, it's much more available to get information and understand the different strategies, how to get access to it. And even outside of institutional investors, where it was previously sort of mostly limited to, now retail investors can even get involved. And it's actually quite a very dynamic industry. It's probably the biggest learning curve I've had, and it continues to sort of expand and challenge, and it's a wonderful place to be. I mean, even through the good and the bad, it's absolutely wonderful. We're not triggered.
Yeah. I'd absolutely echo everything that's been said. I think for me, and why I'd encourage everybody on the call to sort of to go and explore, careers in in the investment management industry in whatever capacity is just such a multifaceted business to be in, and it's massively challenging, and there's enormous variety. And I think for those of you, with that sort of curiosity about the world in whatever way, whether it's politics, business, finance, industries, whatever it might be, you will find it to be, never ending in terms of the sort of challenges and the interest that you get from it. So I think in a sense, that's probably the biggest thing for any of us that have been sort of lucky enough to find our way into the business in one form or another, is that there is that massive challenge, and for those that are intellectually curious, you will definitely find that sort of curiosity satisfied over time.
Thank you so much to all speakers, and what a great note to end our panel today. Just wanted to again thank David, Kelly, and Lucy for taking your time today out of your very busy evenings, as well as for everyone who attended this panel. And we look forward to seeing you at future events. Thank you so much.
Thank you so much for having us.
Pleasure. Thanks, everybody.
I thought you hosted it beautifully.
Thank you so much. Bye, everyone.
Thank you.
Bye.
Bye, Laura.